Hello, everyone, and welcome to this explainer. Today, we're putting on our legal educator hats to decode one of the most critical and, frankly, heavily scrutinized areas of taxation law. We're talking about the General Anti-Avoidance Rule, or JR, under the new Income Tax Act 2025. Whether you're a CA, a tax professional, a student, or a business owner looking at corporate structuring, this session is going to give you absolute clarity on exactly how the tax authorities view your arrangements. Let's dive right in.
So think about this for a second. When does legitimate tax planning actually cross the line into impermissible tax avoidance? This isn't just some theoretical debate, right? It's the exact practical situation JAR is designed to target. It's that incredibly thin, often blurred line between smartly structuring a business to save tax and artificially engineering transactions just to evade it. Today, we're going to draw a bold line right through the middle of all that confusion.
Here's our agenda for today. We'll start with an introduction to GAA, dive into the legal framework, look at commercial substance rules, walk through a practical application example, cover compliance and common issues, and wrap up with a summary and takeaways.
Let's jump straight into Section 1, Introduction to GAR. Now, the biggest question on every tax professional's mind right now is what exactly has changed with GAR in the new act? Well, according to the official FAQs on interplay and transition, specifically question 10.14, the answer is that the GAR provisions are retained as is. They've simply been migrated. So what used to be Chapter XA, spanning sections 95 to 102 in the 1961 Act, is now cleanly housed in Chapter XI, spanning sections 178 to 184 in the Income Tax Act 2025. The thresholds, the approval mechanisms, the procedural safeguards, they all remain fully intact to ensure a smooth transition.
Moving right along to Section 2, the legal framework.
Section 178 outlines the applicability of GAR, but the real heart of the law? That's in Section 179, which defines an impermissible avoidance arrangement, or an IAA. For GAR to be invoked, the arrangement must have obtaining a tax benefit as its main purpose. Now, a tax benefit could be a reduction in tax liability, an increased refund, or even just a deferral of tax. If the primary objective of your structuring is to secure that benefit, well, you're halfway to triggering GAR. But crucially, that alone isn't enough.
To actually cross the line into impermissible territory, the arrangement has to fulfill what we call the twin test. It must have a tax benefit as its main purpose, plus it has to contain at least one of four tainted elements. Ask yourself, does it create rights or obligations that independent parties dealing at arm's length just wouldn't agree to? Does it result in the misuse or abuse of the act? Does it lack commercial substance? Or does it employ non-bona fide means? Look, if your primary goal is tax savings and you check even one of these four boxes, the arrangement is deemed impermissible under Section 179.
Let's move to Section 3, commercial substance rules. The most frequently debated tainted element is by far lacking commercial substance. Section 180 gives the assessing officer the power to look right past the paper documents and examine the actual economic reality of the transaction. Basically, an arrangement lacks commercial substance if the real substance differs significantly from its legal form. Authorities are going to look for round-trip financing, where money just goes in a circle purely to create a tax effect. They'll look for an accommodating party whose only real job is to facilitate that tax advantage. They're going to heavily scrutinize elements that magically offset each other or transactions that have absolutely no significant effect on the actual business risks or net cash flows.
So what happens if you actually get caught in this net? Section 181 details the consequences, and honestly, they are drastic. The assessing officer gets incredibly broad powers here. They can completely disregard the steps of your arrangement, literally treating it as if it never even happened. They can recharacterize capital receipts as revenue or completely deny your deductions. They can pierce the corporate veil, ignoring accommodating shell companies entirely, and absolutely crucial for international transactions, they can outright deny your benefits under double taxation avoidance agreements.
Okay, Section 4. Let's look at a practical application example to see how this works in the real world.
Imagine this classic scenario. Step 1, an Indian domestic company creates a subsidiary in a zero-tax jurisdiction and transfers equity funds into it, but there's no real business operating there. Step 2, that same subsidiary routes those exact funds right back to the Indian parent company in the form of a loan. Now the Indian parent pays interest on this loan, claiming a massive tax deduction on the interest expense, while the interest income just sits untaxed offshore. That is textbook round-trip financing. In Step 3, under Sections 180 and 181, the assessing officer steps in and invokes GAR. They look right through that corporate structure, deem the subsidiary an accommodating party, completely disregard the loan, deny the interest deduction, and recharacterize the whole transaction back to its true economic reality. Boom. The artificial tax advantage is neutralized entirely.
Moving to Section 5, Compliance and Common Issues. Now, before you start panicking about every single tax planning move your company makes, let's talk about the 3 crore rupees threshold. This is your safe harbor. According to Rule 128 of the new Income Tax Rules 2026, which perfectly mirrors the old rules, the JAR provisions under Chapter 11 do not apply to an arrangement where the aggregate tax benefit in the relevant year to all parties involved doesn't exceed 3 crore rupees. And remember, that's the aggregate tax benefit across the whole arrangement, not just the benefit per individual entity. Also, the law provides very strict procedural safeguards, so taxpayers are protected from the arbitrary use of these massive powers. An assessing officer can't just wake up one day and invoke GAR on a whim. Under Section 274, they have to navigate a strict hierarchy. First, the AO proposes GAR and issues a notice. Second, if the taxpayer objects, the AO has to send a reference to the Principal Commissioner, or PCIT. Third, if the PCIT still isn't satisfied with the explanation, they must refer it to a specialized approving panel. And finally, this approving panel, which includes high court judges and top revenue officials, will issue binding directions, but only after giving the assessee a fair opportunity to be heard.
But what if you're advising a client on a massive restructuring? Waiting around for an assessment just isn't an option. You need certainty. Well, as detailed in the new guidance notes, taxpayers can use Form 120 to apply to the Board for Advance Rulings, or BAR. This route is available to any person, resident or non-resident, specifically to figure out if a proposed arrangement triggers GAR. And here's a cool detail. While Section 384.3 generally blocks advance rulings for transactions designed for tax avoidance, it explicitly makes an exception allowing rulings specifically for GAR determinations.
So what are the common practical mistakes professionals are making out there? First, misunderstanding the transition. Please don't assume the 2025 Act rewrote GAR from scratch. The core rules carry over fully from the 1961 Act. Second, failing to properly document the primary commercial purpose of a merger or restructuring at the board level. Look, if your board minutes only talk about tax savings, you're basically handing the AO a GAR case on a silver platter. Third, ignoring the twin test, basically panicking that any tax benefit triggers GAR without checking for a tainted element. And lastly, overlooking that 3 crore RU aggregate safe harbor under Rule 128 when you're assessing risk.
All right, Section 6, Summary and Takeaways. Let's bring it all together.
Here are your key takeaways. 1. GAR is alive and well, now housed in Chapter 11, Sections 178 to 184 of the Income Tax Act 2025. 2. Always remember the twin test. You need both a tax benefit as the main purpose and a tainted element, like a lack of commercial substance. 3. You can breathe a little easier for smaller transactions thanks to the Rule 28 safe harbor of 3 crore rupees. 4. For high-value arrangements, mitigate your risk proactively by seeking an advanced ruling using Form 120. And 5. Know your rights. The procedural safeguards involving the approving panel are specifically there to protect you from overzealous assessments. So I'll leave you with this question. Just how robust is the commercial documentation for your next big client restructuring?
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video. Thank you for watching. Please like, subscribe, and share.